Hey, it's Uyehara with Geneva Financial, and today I wanted to talk to you about how to tap into your home equity if you're thinking about buying a new home. One of the great things about being a homeowner is watching your home appreciate in value, and we've all saw that happen over the last several years. In fact, almost the last decade, home values have continued to go up and up and up and up. So many cities across the country over the last couple of years saw double-digit increases with appreciation. So I know you got some home equity, but what do you do with it? How do you tap into it? And especially for those of you that are thinking about buying another place, I'm going to explain everything and how you can make that happen. So let's hop right into this video. So when we're first thinking about home equity, what is your home equity? So your home equity is the difference between your loan balance, if you have one, and your estimated property value. So let's take a look at what that looks like. So let's say, for example, on this house, our value is $500,000. And let's say we owe $300,000 on this house. That's our loan balance. So the difference between the 500 and 300 was $200,000. Simple math here. This is going to be your equity. So when you're thinking about how to buy a new property, remember some of the things that we look at when it comes to mortgage financing, you're not able to tap into the full amount. The only way you can do that is if you sell your house. But remember, even when you sell your house, you still have to pay commissions and fees, and maybe you're helping the buyer with closing costs. So you're not always going to get 100% of your equity in your property. But in this case, we have about $200,000 to play with in this specific scenario. So let's say you're wanting to move and purchase another primary residence, and the house that you're currently living in, you want to turn that into a rental. So there's a couple of ways that you can look at tapping into your home equity in order to make this happen. Now, the first thing that you can look at is called a HE loan, which is a home equity loan that not all banks offer. In fact, I wasn't even really aware that a HE loan existed until I went to my credit union several years ago. It's similar to a home equity line of credit, except you cannot draw on the loan. It's just literally they give you the money after you close on the transaction. So for those of you that bought your house or refinanced a couple years ago and you have a 2 or 3 or even 4% interest rate and you don't want to lose that, which so many of you are out there trying to protect that as much as possible, and I don't blame you. If you did a HE loan, you wouldn't touch your first loan. Your first mortgage does not get touched, so that interest rate stays there. So let's just say in our example, you would get probably 80% loan to value. That's kind of what I've seen across the board, even some of these other examples that we're gonna talk about here in a little bit. But again, that's one thing you can always check if you're shopping around trying to find a bank to help you out with your HE loan or HELOC or anything else that we'll cover here today. So let's just say in our example here, on a $500,000 house, again, and let's just say we are gonna tap into 80% loan to value. This means the maximum amount that the bank will lend to us is now going to be $400,000. And remember, we still owe $300K on the house. That's our loan. So we're only going to be able to tap $100,000 in this situation. So this is why, again, don't get super excited if you haven't talked to a lender yet or trying to figure out what you're going to do, because in these scenarios, so many times homeowners think that they can just tap 100%, but remember, the banks are gonna do that. That's what got everybody in trouble back in 2007 and 2008. So there's always gonna be some sort of loan to value or some sort of buffer that the banks wanna take as a precaution for the bank's perspective. So that way, in the event the market shifts or anything happens, they have some leeway on the deal for themselves. So in our case, if you did a HE loan, you could probably get $100,000. The bank will then give you a loan. It'll be now a second mortgage on your property, where now you have to make payments on your first mortgage and the HE loan in order to go ahead now go try to buy your next property. So now this moves me on to point number 2, which is a HELOC. This is the most common thing that so many of you have been asking about, because again, we want to protect your first mortgage. We don't want to touch that interest rate, which again, I don't blame you for doing that. But now with a HELOC, it's similar to the HE loan. Only difference is that a HELOC is like a credit card. It's a credit card that's tied to your house. So again, we're not touching the first mortgage. That interest rate stays the same. But on the HELOC, typically they are adjustable rate mortgages, depending on, again, the bank, the lender you talk to. I've seen a few out there that offer fixed rate HELOCs, but most that I've seen or I've even done for myself has always been adjustable. And typically the first 10 years that you can draw on the HELOC is interest only payments. So unless you're paying over and beyond whatever your monthly payment is, your loan balance is not going to change. That's where it can get a little scary, because I know a lot of you, if you're buying another property, I'm hoping you're buying a property that's going to be producing cash flow, or you're going to turn your current home into a rental property so you have some sort of income that's coming in that can service the new debt that you're creating. I'm not a huge fan of taking on more debt that's not producing income, especially in today's market, because we don't know how much longer this is going to last. We don't know when the economy is going to take a turn for the worse. I still think it's going to get worse before it gets any better. So to me, I'd rather be safe than sorry with any sort of additional debt that I'm taking on right now. So with the HELOC, there is no payment unless you start to draw on the line of credit. So let's just say in the same example, let's say the bank gave us an 80% loan to value loan. So again, we have a HELOC, a line of credit of $100,000 on the house. We close on the transaction. I don't have a payment until I draw on the funds to use it towards maybe the down payment for my new home in order to close on the new property. But this is where it gets a little tricky, because when you're taking out this HE loan or this HELOC, you're adding a second mortgage or a second payment to your overall debt qualification. Now remember, any lender is going to look at qualifying you the same way. We're going to pull your credit, and whatever debt shows up on your credit report is what's being taken into account to figure out, can you qualify for the new mortgage? So this is what I would recommend you doing. If you're thinking about taking out equity to buy another house, talk to a lender first. Don't go out and get the HELOC or get the HE loan first, because that lender may not be licensed to do business wherever you plan on buying. I would make sure that you're working with the lender that essentially can handle both transactions. And the reason why is because it makes the process a lot smoother, a lot easier. Because let's just say, for example, if you called me and we were looking at your HELOC, I can figure out your HELOC payment, and I can also do your pre-qualification for your next house that you're buying, because I already know what the debt payment is going to be, whether it be a HELOC or a HE loan. Now, if your loan officer doesn't know that number, he could miscalculate the numbers and say, yes, hey, go buy a house. And he didn't know that you took out the money or borrowed the money in order to get the down payment. It's little calculations like that that can completely kill a deal. And it's something that you might not think it's a big deal and it's just an oversight, but it's a massive issue if the loan officer that's doing the purchase transaction has no idea about the HELOC or the HE loan. Now, when it comes to your home value, a lot of times you might look at Zillow or Redfin, or even sometimes a lot of loan officers have some sort of data provider that can give them a rough idea of what your home value is. I know with all of my clients, when you close on your house, we do give you access to a database that we have that can actually give you estimated values of your home. But it's not anything that we want to take for gospel, because again, it's an algorithm. It's pulling data from multiple sources in order to give you a rough estimate as to what your house is. So what we want to do is we really want to talk maybe even to the real estate agent that helped you close on that property. Have them give us what we call comps or comparables. They're going to look at comparable sales in the area to give us a determination as to what they think the home value is. That will be the closest that we can get without having to pay for an appraisal. Now, if you go through this process, of course, once you do decide to move forward, you will have to get an appraisal on your house. That's how the bank is going to determine the true value of the property in order to figure out the calculations that I described to you. Some lenders may not require a full-blown appraisal, because there's so much data out there that sometimes the banks have online evaluations that they can utilize in order to determine what your home value is. Typically, an appraisal is going to cost you anywhere from maybe $500 to $700, depending on the type of property, depending on where it's located. So do be prepared to pay for some of that up front. Now, if you're looking at Zillow and Redfin, remember, you can't take that as gospel. That again is also an algorithm. They may give you a rough ballpark as to what you think your home is, but don't get disappointed if you go get an appraisal on your house and it comes in less, simply because, again, those websites are just giving us a ballpark as to what they think the home values are. So another scenario we can look at as far as tapping into that home equity without selling your home is a cash out refinance. Now, this is one thing that not a lot of you are excited about, because again, if you bought or refinanced over the last several years, you have a really low interest rate, and it pains you to lose your 2 or 3% interest rate and take 7% today. So if you're going to be doing that, the numbers numbers have to make sense because you're giving up a really, really good interest rate in order to take on the new rate today. Now, when you go through a refinance, here's the process that I go through with all of our clients. The first thing we're going to do is ask you to send us a mortgage statement because that's going to show us roughly what you owe on the house, and we're going to start to figure out what that home value is. So now we can see how much equity do we have to play with for us to make that determination, so we can do an analysis to show you this is what your current mortgage payment is. Here's maybe one or two options, maybe even three options that we could show you to do a refinance. You can see side by side what the loan looks like, how much your payment's going to increase, because remember, your loan balance is going to go up. In our case that we've been talking about here today, I owe $300,000 on this house. If I take out $100,000, my new loan balance is now going to be $400,000 at today's market rate. So not only is my loan balance going up, but my interest rate is going up too, which means my payment's going up. So this is where it can get a little complicated when you're trying to do two things at once. But again, nothing new for me and my team. This is stuff that we do every single day. And this is why, like I said, one of my tips, key tips, if you take anything away from this video, is I would work with the same loan officer that's doing both transactions, simply because they know the numbers and they can put both of them in at the same time and make adjustments as they need to ensure your deal gets done as you move forward. So cash out refinance is the third option, not the most popular option today simply because of interest rates, but it is another option that you can look at without having to sell your home. Now, another option you can take a look at is what's called a bridge loan. So on a bridge loan, you are essentially tapping into your home equity before you decide to put your house on the market. This is something you can take a look at if those three other options that I've talked about just doesn't work for you for whatever reason, and you do have to go down the path of selling your home. So the cool thing about the bridge loan is that there are banks out there that are willing to let you access the equity of your house to then go buy your new property. And then now you have to then sell your property typically within a certain amount of time, so that way you don't have to necessarily service both mortgage payments, because that house should be sold. It'll wipe out the bridge loan that you got in order to buy the new house. So you're obviously not going to walk away with a ton of proceeds from the deal, but it is another way to get your money, so that way now when you are writing your offers, this is one thing I hear a lot of my agents say that it's a big problem these days, is that the listing agents out there do not want to see contingent offers. So what I mean by contingent offers, there's a spot on the purchase agreement that you have to stipulate to the seller that, is this purchase that you're trying to buy their house, is it contingent upon anything else that's out there? And if it is, you have to notate that. So what happens on the selling side is that they look at that and they think that you are a weaker buyer simply because your down payment is coming from another house. And again, that doesn't guarantee that the house is going to sell in time, or that doesn't necessarily mean that you're actually going to get those funds within the time that's allotted on the contract. So there's all these other hurdles that can come up that a lot of agents don't want to deal with because they want to close as fast as possible so they can get paid. So that's another way that you can eliminate the whole contingency thing that a lot of people don't want to see on contracts. Here at Geneva Financial, we're actually rolling out a bridge loan product soon. So if this is something you're looking forward to, make sure to send me an email so I can get you more details on it. Out of my 15-year career, I've probably worked at one other bank that offered a bridge loan. So this is something that's not quite readily available to a lot of people. I'm super excited about having it because I know it's going to help a lot of our clients be able to get the equity they need to then either go buy another property, or to either go buy another primary residence or go buy another rental property. So I'll keep you posted on that. And last but not least, it's selling your house. If all the other options that I've just mentioned today do not work for you for whatever reason, you are going to be forced to sell your house. That is the only other way you're going to tap into your home equity to then go buy that next property. Now, of course, with this option, you don't have to worry about managing two mortgages. The lender can already calculate that you're going to be selling your home, so they can remove that debt from your pre-approval when you're looking to buy your new home. This, obviously, again, like I said in the beginning, you're not going to get 100% of your home equity. You still have to pay the buyer's agent's commissions, the listing agent's commissions. If you're offering to pay any sort of closing costs to the seller or offer any incentives, that's going to come from the proceeds of the sale of the house. So make sure that when you're talking to a real estate agent, they give you what's called a net sheet. The net sheet is going to break down everything on the transaction. from the commission splits to title fees and any other fees that may get thrown into the transaction, so you can see what you can walk away from the deal. Now, this is something that's important because as the market is shifting, and we've seen the market shift pretty quickly lately, you want to make sure you're working with a realtor that can market your home properly. Because in a market like we're in today, good homes that are priced right, that look good, they'll sell quickly and they'll get multiple offers. If you're priced too high or there's something wrong with the house and your house sits, the more the house sits, a buyer thinks that there's something wrong. And of course, they're gonna come in, they're gonna lowball you. So you wanna make sure you're getting the right marketing so that way you can get top dollar for your house and then go buy your next dream home. So for a lot of you that bought your first home and you weren't being super greedy, props to you for doing the right thing, because now you can take advantage of this opportunity to go buy your new home. This is why I always say this on the channel. You know, buying your first home is just stepping stone. This is gonna get your foot in the door into home ownership. As you live in your house over a few years, you start to build more equity. Then down the road, whether it's your second house, your third house, maybe that's when you now go buy your dream home, or you go buy some rental property and you start building up some equity, or you start building up some cash flow. So there's a lot of benefits that you can have by simply owning one property. This is why I love home ownership, because it gives you so many options down the road that you may not be thinking about today. So share this with a friend that might be thinking about buying another property. So, and if you need a loan pre-approval or a mortgage refinance, don't forget to send me an email and share this video, because I appreciate all the love, and I'll see you on the next one.